my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here is your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. I retired 2 bullish pitchforks recently. I've retired another one today. The pullback from the drop in late August dictated that I should, as the subsequent bounce we saw 2 weeks ago ran out last week. I had pointed out such a possible scenario last time, and I quote, "The very recent 50% Fibonacci line at 182.75 amidst the gap would be a useful guide for a pullback. The only issue of that is as prices rise, so does the value by a factor of a half." End of quote. Now, prices did reach there and overshoot on the downside. I pointed out as much recently when I said as prices actually dropped below the 50% Fibonacci line 3 Mondays ago, and I quote, "This could be due to 2 things. And the first one is on overshoot, in which case we'd see a pacification of the market in the next few days, or 2, a move down to fill the only gap left in the move up between 168.45 and 169.55. Right now I'm not sure which, but the ammunition overhead has mainly been spent in getting down here, so it would require a special effort to go that extra down to the gap." End of quote. It was indeed too much effort. And prices pulled back up to the Fibonacci congestion at 191.02 to 191.08 2 weeks ago, before moving down a little last week. Question now is, what's next? Well, we have one of 2, maybe possibly 3 choices. The first choice is the recent action is a build-up of a bearish halfway hesitation, with an ultimate move down into the possible 152 area. The second choice is we have a basing action, a build-up of ammunition for a fresh attempt at the 191.02, 191.08 area, and ultimately the July high at 217.85. The third is we travel along sideways, as the excessive energy build-up caused by the sharp rise and sharp fall dissipate their rhythmic vibrations, and we then look to a new pattern sequence, possibly. I'm not sure which of the 3 is right, but option 3 seems reasonable given the recent action, for now at least. London coffee. It feels like the April to May bullish Andrews pitchfork, though broken, has nevertheless been with us a long time. And it has, I suppose. Actually, has only been in operation for 3 months, and it started getting breached at the end of July as well. That being said, I would defer from calling it broken, as despite the multiple breaches on both sides, it still shows the bullish angle of attack of this market. This can most clearly be seen over the last 2 weeks, when the market has been below the lower time, currently 1907, but has still utilized this lower time like a washing line to run along the underside of it in a bullish manner. Now, most recently prices have broken up and closed over the 2018 high at 1845 and the very recent 50% Fibonacci line at 1868. It is mindful to now remember that the move up in late July ran foul of the overhead congestion between 1968 and 2004, and that includes the October 2017 high at 1999. You see, earlier bullish actions were either ultra aggressive or half-hearted, hence why the overhead congestion at 1968 to 2004 area was so effective. It is clear that the bullish incentive is still alive here, as is, after a fashion, the Frankenstein bullish Andrews pitchfork, the congestion at that 1968 to 2004 area. So for now, just keep an eye on the rising lower time to guide the bullish incentive high until we get closer to that 1968-2004 area. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.